Lead a life of entrepreneurial freedom with insights from successful creatives, entrepreneurs, and investors. Discover how they overcame challenges and turned their biggest dreams into reality. They share their personal success playbook so you can build the business and life you truly want. Welcome to Passion Millionaire, the podcast by Robert Roth. Rock and roll your dreams.
Welcome to today's episode of the Passion Millionaire Podcast. Again, as usual, I'm super excited. And today we have a different angle for all of you entrepreneurs and all of you investors especially. Today we have an expert in real estate, and he's an expert because he's not only worked in the real estate space for a very long time in all kind of different roles and collected a lot of expertise, but he has his money as well where his mouth is. And that's, for me personally, always counts twice, at least when somebody puts his own money where the expertise is, because then you know they really know what they're talking about. So we know whatever Leo, our guest today, is gonna let us know, is inform us about, like, that has a lot of weight. And I'm very excited about that. So he's in the real estate space currently. He's the founder of the Cornell Communities, which is a real estate investment firm focused on acquiring and operating manufactured housing communities. And in general, he has generated more than $75 million in real estate sales. So that's quite a noticeable number. And he personally also has achieved financial independence, which is what all of us either already have achieved or are after to achieve, because it definitely makes your life better once you have that financial pressure off. So therefore, I'm excited if Leo is going to go ahead and share some of the insights as well, how he was able to achieve that. And I'm excited to actually hand over to you, Leo Young. I'm welcoming you and I'm excited to have you here on the podcast. Please feel free to correct and add my intro as necessary.
You did a wonderful job. Thank you, Robert. I appreciate you having me here, and I appreciate the intro. So, yeah, my name is Leo. I'm the founder and managing partner at Cornell Communities. And what Robert mentioned was good because I've had some would say an interesting winding career. You know, me being in the private equity space right now, I wasn't the perfect candidate for it. It's not like I went to investment banking, did this, that, the other thing. Actually, so I studied finance in college. I graduated. I took a pivot. I went into sales to sort of face my fears of selling. But I think just like giving presentations, like talking to people, like back then, that was something that I really wanted to get better at. And I was working at Tesla. Tesla was my dream company at the time. And when I was there, it was a very intense period of the company's history because they almost went bankrupt. And literally everyone was a hater in Tesla. I couldn't tell you how many people. It's a very different world now, but nobody believed it back then. They're like, oh yeah, Tesla, is that owned by Toyota? Like, oh, what happens like if Tesla goes out of business? Like, will the cars be around? Like, oh, these are the cars that catch fire, right? But anyway, so in there, you know, it was a really intense experience. I learned a lot. It helped shape my work ethic, but then also it burnt me out because we were getting worked very, very hard. So that's where I sort of looked to different alternative options in terms of financial freedom, independence, and, you know, stumbled upon some real estate forums, read up about them, learned about passive investing. And I thought to myself, wow, that's a pretty good concept. I mean, I just invest with people that I like, invest in projects that I like, and basically they work to make money for me. And that was a really cool concept. So started doing that almost a decade ago, and just through the years built up the financial independence, which is more or it was less momentous than I thought. You know, your freedom day. You know, people like Kiyosaki, they talk about that in Rich Dad Poor Dad. About having your cash flow be higher than your expenses. That's when you're truly independent. But yeah, I think it's a lifelong journey. You know, then from there, got my real estate license. I started helping people to learn and earn. I help people all different, basically walks in life, from affordable rentals to luxury mansions to multi-million dollar commercial projects. So I learned a lot. I've spoken with a lot of different kinds of people and have their perspectives. Then I worked at a real estate fund. I think it was like $4.5 billion that we were helping them to
Yeah.
purchase. So buying assets nationwide, and then got the great idea to start my own firm with a co-founder. And here we are later, fifth year in business. We're doing great. We're ahead of business plan, and making a lot of investors a lot of money.
Sounds great. Yeah, almost too great to be true. But
There's a
it's
lot that
so
goes behind this. Yeah.
yeah, that's right. I mean, I think that's a great asset that you have seen your space real estate from so many different angles that you probably can connect dots differently than somebody who hasn't done that. Like I could imagine somebody who's a real estate agent for, probably also decades and knows exactly what he's doing and is really good at this one thing, couldn't handle some aspects that you are handling the way you are handling them. What would you see a
Yeah.
difference there maybe? Because
Yeah.
you know exactly what you're doing right now, especially also the investors that you're working with, right? Maybe you can speak a little bit about that. Who are those typical investors you're working with, people that are looking to get into real estate, right? And then what are the things that you are making sure are handled super well?
Yeah. I think a lot of investors, they sort of know, or a lot of people in general, they know the benefits of real estate, right? It's like, it's an asset that will always have demand because like everyone's going to pay rent every month, right? So we sort of go based on that. But then the next step, it's like, how do I invest? Like what's a good deal? And like, how much work do I want to do? And that's where a lot of people, they sort of have varied directions. So a lot of the investors that come to us, they're usually one of two buckets. They're people generally that are crushing it in their career, doing very well, and they're asset rich but time poor. So they're either doing really well in their careers, they're like a VP director or something like that. They have a family, they have a lot going on, they're making good money, but that money sitting in their bank or in the S&P, that's like kind of volatile. It's like here or there.
Mhm.
And they want something different. They want to create that financial base so that they can have predictable cash flow that basically doesn't rely on them showing to work. Because in this job market, there's like a lot of downsizing happening, a lot of like unpredictability, and that's led a lot of these people to search for that kind of financial foundation. And a lot of people, they're later on in their careers, like they're like, oh, I should have started doing this like 10, 20 years ago. So they come to us wanting to build that financial foundation. And the second bucket is generally successful business people. So they're running their business, they're doing very well, and that is their unique value to the world. They're doing really well in it, whatever business that it may be. But obviously, like they have money that they're not putting to work, and they don't know how to work, and they seek this opportunity because they invest with people that basically we set up a whole company to do this one thing. So our investment thesis is very, very specific, and we sort of proven that this is a machine that we can operate time after time after time and get investors consistent returns. So these guys like it, they understand the importance of investing, and also to them too, having that level of cash flow, that level of sort of passive wealth building, it's very important to them because business, like a lot can change, right? I mean, during COVID, overnight businesses were turned upside down. So
Mhm.
they want to just make themselves more financially invulnerable. So those are the two general buckets.
Yeah, makes sense. And now that you are in, manufacturing housing communities, so what makes this type of investment special?
So it's a very unique asset class to the United States. And especially in this market cycle, it makes a lot of sense to invest in because the call it the three main forces. One is that there is a big supply constraint. So they're not building any more of these. It's a very unique asset class that it was popular 50 plus years ago, but they stopped allowing it. So the local governments, they stopped allowing it because it just doesn't make sense for them. So we can only buy existing ones, and it just makes the existing ones more valuable. The second is it's very recession resilient because it's the most affordable form of housing that's not government subsidized. So you don't rely on whoever is, in the government, in the White House to say like, hey, the checks are good, because
Like Section
there
8.
was a period in time. Exactly. Last year, there was a period of time that, it was called into question. It was like put on
Oh,
pause
really?
and like, yeah, people took it for granted. And then they're like, oh, wow. So it's not a certain thing. But so this is the lowest cost form of housing, and people always want it. So we have wait lists at all of our communities. Like, people just want them, but there's just not enough supply. And the third reason is that there's opportunity for increasing the value. So for us, we're value add investors. We want to buy a property because we know we can add value to it. And a lot of these assets, these manufactured housing communities, they come from older owners. Like, we speak with a lot of sellers, like they're in their 70s, 80s, they've owned the property for like 30, 40, 50 years.
Mhm.
And there's a lot that can be done better, like giving residents a way to pay rent online, improving where they live, repaving the roads, like increasing the lighting, things like that. And of course, like, normalizing the rent. It's usually very, very below market rents. So, there's like room for growth, and it's still supported by local market comps. So that's sort of how we increase the value of the property and make the money for our investors.
Yeah, interesting. And also, at least that's something I have observed when I was whenever looking through Zillow.com, etc. It seems to me that a lot of those manufactured housings also are on leased land. So therefore, um, correct me, please, because like
Yeah,
it's
you're
just
right.
my personal observation, which might be just a
Yeah.
small region of houses that I might have checked, and it's the case
Mhm.
there or whatever. But how would you deal with that? Like, are you usually making sure
Yeah,
to buy the land with it? Because I mean that makes a difference, right? Or how does it look like when you
definitely.
do it?
So that's what makes this business model so unique, is that the residents, they own their own homes, but we own the land. So think of it like an HOA, like you're in a
Yeah,
condo, right? You pay the
right.
HOA fee every month. They do the maintenance. That's pretty much what we do. So we maintain the roads, we maintain the utilities, we give them just generally a place to put their trailer. So another nickname for the manufactured housing communities is a mobile home park.
Right.
So
Yeah.
that's generally, it came from the term of a mobile home parking lot. So
Right.
we maintain the parking lot for them to put it there. And how that translates into the investment world is that it's a very simple asset class to operate. There's
Yeah.
a lot fewer
Very
moving
smart.
parts, fewer things that can go wrong. I mean, right?
Exactly.
If you're,
The wall.
yeah,
Yeah. Things that
exactly.
break that are expensive, kind of.
Exactly. Yeah. I mean, look, if you're talking about like an apartment building, like you have the roof, you have an elevator. An elevator can only be serviced by a certain vendor. You need a leasing team. You need to figure this whole thing out. So it's a very simple business model. We're able to just run it time and time again, and just have a good visibility into like how each asset is doing.
Mhm. Yeah, I believe that is a very smart investment vehicle. Like I've heard people that are
Yeah.
pretty big in the YouTube scene, real estate investor YouTube scene, also talking about that and
Yeah.
showing even, hey, I've invested in this mobile home park and this is how it turned out. And I think it's very smart because of, it's risk averse compared to other real estate investments. So therefore I'd be curious, like, let's say I would go ahead and invest in with you, together with you, like how would that look like and what is it I would get? What would I own? What would I not own?
Yeah.
How would cash flow look like? What is the minimum, maximum investment? To get an idea about that as well.
Yeah. So for us, we operate simply with the private equity model. So we pool capital together from investors to purchase larger assets than each of us individually can. So basically, we would be partnering in a deal, and we would purchase this one specific property. And to that, you're a part owner, and then you get a portion of the upside and downside of the actual property itself. And generally, what that looks like for you as an investor is you would get a stream of cash flow because basically people pay their rent, we deduct expenses, and then you get your cash flow. So you do that. And then
What's your
also
management fee on that?
it varies typically. Um, and yeah, for us, it's around between like 2 and 3%. But I think it's hard to compare apples to apples when it's like the actual percentage points because you know the percentage point for or the dollar amount for a $1 million project versus the dollar amount for $100 million project is substantial, right? And for us, what the management fees go to, typically it's just expenses and payroll because we need staff to support the actual properties to make sure that they're operating well. Because we don't want a single point of failure that's just like people are understaffed and like the properties aren't being served well. So generally we operate at pretty much cost, if not slight cash flow negative. So like meaning that we as a company we supplement, to pay payroll.
So
So
how do
that's
you make money then? Like you put your own portion of your own cash into the project and then
yeah.
equal amount of cash flow?
Yeah, so there's two ways. So one is that yes, we also invest alongside our investors because the projects that we bring to the table, we like it ourselves. We just don't have enough cash in hand to buy it ourselves. So that's one way. The other way is called like the profit sharing. So we have return metrics that we value that we measure the project on, and if we exceed it, then we get a certain portion of the upside. And if we don't exceed it, we get nothing. And we're not a charity, so
Yeah.
we operate for that upside. And basically, when you refinance, when you sell the property, that's sort of when we actually get included in the profits.
Okay. Yep. Understand. Makes sense to me. And then how would that look like for an investor? Let's say I would invest with you. Like, what's the minimum investment, maximum investment? Might also depend now on the size of the
Yeah.
project, as you just mentioned. But
Yeah.
interesting
It So
to know.
generally, it depends project to project, but kind of like general figures, one deal that we've done in the past, generally, for us, we want to keep our minimums as low as possible. I know in the private equity world, there's a big range in terms of minimums. So like the fund I used to work for, their minimum was $10 million. In other ones, like they might have like 250,000. But for us, we want to make it as accessible to individuals as possible. So we make it typically around 50,000. We try to keep that for as long as possible because there's obviously costs associated with compliance and all that stuff. So we generally don't go too much below that. So that's sort of something to keep in mind. As far as the returns, generally like cash flow is around 6 to 8% per year. So, let's say you invest 50,000, then that's $3,000 to $4,000 in extra cash flow that you're building per year for basically the project. And as far as the upside, we generally want between 15 to 20% in total returns. So simply put, we want to double
That
your money once
includes
every 5 years.
appreciation or
Exactly. So we add value to the property, and that's what the end of the rainbow looks like. So we want to double your investment once every 5 or 7 years.
okay. And is there a goal to exit those properties, or is the goal long-term hold?
Generally, longer term, because these assets they perform best longer term. The What makes sort of manufactured housing so unique is that it has some of the lowest default rates in the entire real estate space. So it's generally better to hold on to it. There is a lot of big financial institutions coming into the space. So like Blackstone, Apollo, Equity Lifestyle, Sun Communities, like all these big REITs, they're coming in and they're buying at just valuations that don't make sense to us. And
Okay. Yeah.
because their investors are able to accept lower returns, that's how they're able to
And
to
they have
purchase
too
the
much
asset.
money probably, and they need to position it somewhere.
Exactly.
Is that
Exactly. So it would be beneficial to hold on for the longer term for us to compile a portfolio and then sell it to them at a much better valuation. But of course, if there's like another reason to do so, if there's an opportunistic price, if someone makes an offer that we can't refuse, like yes, like we'll consider it for sure. But generally long term hold.
okay? Interesting. Yeah. And how would that agreement generally look like in case somebody invests with you? Like, how is that being
Yeah.
structured also? Like
Yep.
how is the ownership structured and stuff like that?
Yeah. So we're governed by the SEC, the Securities and Exchange Commission. So there's a lot of kind of paperwork that we have to do correctly and file correctly. So basically, there's a big document that outlines all the terms and like what to expect. And generally, the relationship is that you're a limited partner and we're the general partner. And what that means is that
Yep.
as a limited partner, your exposure, your liability is limited. So it's not like if something goes wrong, like, I don't know, like a tenant can sue you. No, like us as the general partner, we have general liability. So like
Mhm.
we have unlimited downside. So we basically take that, we sign on to the loans. If something goes wrong, like the bank seizing all our assets. It like we don't want that to happen. So like we will make sure that it doesn't happen. So that's kind of the relationship between the two and basically what to expect moving forward. Generally there's investor portals, there's like quarterly updates, like we share with investors what's going on. They can reach out to us anytime. We have like conversations with investors all the time just to let them know like here's what's going on, like what are your thoughts, what are your plans, and we sort of take that into account too because we want to serve our investors and give them good opportunities.
Hmm. Yeah, makes total sense to me. Very interesting. I'd be curious, like, is there anything you could tell about the best of those properties that you have invested so far, and how was it different from the worst one?
Yeah. That's a good question. So the first off, I mean, with anything, there's always a risk, right? Like nothing risk, nothing rewarded. So and even like the safest of the safe things, like treasury bills, like they have technically a risk. Like if the US government goes belly up, like
Right.
that's a risk. So with that being said, yes. So like most of our projects have exceeded the business plan, fortunately because we underwrite very conservatively. So what that means is just that the assumptions that we make, like where we can bring rents to, where we can increase or decrease the expenses to, like we're generally very, very safe with that. So we like to just make sure that there's enough buffer in the business plan. So, one success is like, we purchased this property in the southeast. It was a little under 80 units. It was a distressed property that we took on. It was very hands-on. We cleaned it up. We improved the landscaping, the lighting, signage, everything around the community. We just gave them a better quality of life. We brought the rents up closer to market, and that asset. So we were initially targeting because that was more aggressive, we were targeting a 2x by year 4.
Oh
Um,
wow,
and yeah, and fortunately, we 2x in 18 months. So investors are super happy.
not bad. Yeah.
Because like, yeah, I mean, if you put in 50K, like right now you're at 100 in
Mhm.
2 years ahead, 2.5 years ahead of business plan. So everyone's really happy about that. But it was a lot of work that went into the background. It was a lot of like coordinating with the government, like getting permits approved and like bringing in units and all that stuff.
Mhm.
So that's one. Another one that did not go according to plan was so there's the concept of resident owned homes and park owned homes in these communities. So to what you said earlier, we generally like when the residents own their own homes because they're basically responsible for their own maintenance and
Right.
anything like that. So we purchased one
Feel
that
treated
was
better. That's makes for
exactly
everybody in the end, right?
yeah, exactly.
Yeah.
We purchased one that was majority park-owned homes, and we got it. It was an attractive basis, but basically a lot of the properties, like the homes itself, had deferred maintenance. It was just old homes, and like the tenants were not treating it well through the years, and basically the previous owner was just not picking up the phone. Like she was ignoring phone calls and stuff, and like not making the repairs. So like when we took over, all the phone calls came in, and we're like, okay, we did not expect any of this. So
Okay.
that dug into a lot of our reserves, but fortunately, it was very hands-on for us. We got inventory of all the homes, like issues that are going on with each one of them. We sort of had to, move some residents around in different homes into better homes. So then we were able to get over that hump. But it was far more internal pain and and frustration to go through than you see on the surface. But fortunately, we're turning the corner in that. And, they speak about the J curve of acquisitions in private equity a lot, is that
Mhm.
when you purchase an asset, it always gets worse before it gets better. That's sort of the plan. But,
Yeah.
you know, our goal is to make that J as small as possible, right? So, this one was just a bigger J, but, we are turning the corner.
Okay, I hear. So the corner is still turning. It hasn't fully turned.
Exactly.
Okay.
Yeah, yeah. It's on the way up now.
All
So
right.
we're doing much better. We're selling the homes, and like we're actually getting more residents that are, paying closer to market. So it's on the way up.
Okay. Yeah. Interesting story. I could imagine there's, as everywhere in business, more things that could go wrong than we would be able to think of beforehand.
Yeah,
As long as you
for
can figure them out and you're stuck with the thing in the long term,
yeah,
with a long term view and mindset and handling it like that,
yeah.
unless it
I,
was a complete mistake, which hopefully is not
right.
happening, then we should be fine in most of the
Yeah.
cases. That's kind of how I would interpret that.
I think the fortunate part about being in real estate is that it's a really well-defined formula for business. It's like,
Mhm.
people pay rent, you make sure that your expenses are lower than that, and that's it. You're making a profit. So, with that being said, too, yeah, I mean there's complications, but also like we have a very capable team that are they're very hands-on. They're not afraid to get into it. Whereas, some larger firms, they point the finger, oh, macro economy, oh, this, that. And like they're sitting in their office and like, with their nice suits on. But like, no, like we go and we visit the property. Like I've physically lived at a property and like I was there for 2 weeks just to, make sure that things are going well. And sometimes you have to do that. And fortunately, like our team, like we're ready to roll up our sleeves to make sure that the projects are doing good.
Mhm. Yeah. I'd be curious also because you have mentioned, for example, um, if you had invested in this really good property, right? You put 50K in, and then 18 months later, it's technically worth
That's not normal. That was the
double. That's not normal, but or whatever that is. Let's say
yeah,
7 years later, right? It's
yeah,
worth double, right? So
yeah,
that would be more the normal case,
yeah,
if I got you right.
yeah. 5 to 7 years. Yeah.
The way the deal is structured, like let's say if I would do that, right? I have
Mhm.
invested 7 years ago, 50K. Now it's worth 100K.
Mhm.
Um, can I borrow against this equity?
Ooh. So you might be able to. That's not something that we deal directly with because we're not broker dealers essentially, but there is a market for it, and a lot of people like they they borrow against their assets. That's like the whole buy, borrow, die strategy that a lot of like rich people use, and like now. People like Elon, right? He has a ton of Tesla shares. He borrows against it to, have his living expenses and like the amount borrowed is not taxed because it's not a taxable event, blah, blah, blah. But yeah, I mean, a lot of people do that.
Okay, so it's possible the way it's structured that you could do that if you would decide to.
I don't see why not. I personally don't have experience with that, but I'm sure there's like a lot of different financial kind of methods out there, especially in America. Like they have all these different things. Like I get pitched like all day, just like with different things and unique cases.
Yeah, I could imagine.
Yeah.
Yeah, it's a detailed question, but
Yeah.
it would make sense for me that
Mm,
this question could come up for
that
some
would
people.
Yeah, yeah, yeah. That would be interesting. And yeah, I mean, generally, like a lot of our investors, like they they have the money laying around. It's just like stuff that they want to put to work and make it work
Yep.
harder. Or a lot of people actually they do they invest from their retirement account. That's what people don't know is that in your retirement account you can do that, and obviously in your IRA it's tax free. So that just further increases their return and like helps them along the way too.
Yep, 100%. And I'd be curious also. This is not only for accredited investors, but it's available basically for anybody who has enough cash to be, you know, putting 50K in position with that, and that's it. Or is there any
Yeah,
limitations
yeah.
for investors, or how would
Mm.
that look like?
So generally, just in this space, like most of the opportunities are for accredited investors because traditionally, right? I mean, I would call it 2011. There was like when the Jobs Act was passed and allowed these things to happen. But pre that, it was like super wealthy family offices and things like that. They're investing in private equities because it's just like much stronger returns than the public markets. And for them, yes, it is still most of the opportunities for accredited investors, and which just means basically, if you're an individual, you're making 200,000 a year, or if you're a couple, you're making 300,000 a year, or you own over 1 million in assets excluding your primary residence. So that's one way. Another way is sophisticated investors, basically investors that you have a personal relationship with, that you kept in touch with, and over the years, they sort of learn more about it. They're like, okay, I understand what this is. I like it. It fits well with my investment plan. So let's do it.
Yeah, that's good to know, I believe.
Yeah.
Then it's easy to figure out if I can do this or
So
cannot do
easy
this.
answer is like technically anybody can.
Yeah.
And I gave you kind of the more like compliant answer is like, hey, here's how they define it. And there
Yeah.
are certain opportunities that are only for accredited investors. There are others that are for both.
Yep. And then also, like, maybe somebody is thinking, why do I need you and why don't I just go ahead and do it myself? Like,
Yeah. Yeah.
because
I mean,
technically you could go ahead and decide, hey, I'm going to buy this thing. If I don't have enough money, I just find the money in my network or
yeah.
wherever and get it done myself, right?
Absolutely, yeah, and a lot of people do that, and it just depends on what you want as far as your career goes. Because some people they have time but not money, and then other people it's vice versa. So it generally depends. And the one thing to note, if you're looking to buy your own property, is that especially commercial property, it's very unforgiving. You don't get the typical like consumer protection that you do when you're buying a residential property. So just make sure that you know what you're doing. You have enough in reserves, that you're underwriting conservatively, and also just budgeting more time and headaches to that than you expect, because things go wrong. Residents nag you. You get called into like meetings, and like there's a lot of things that go on behind the scenes. And we have a team of 15 people to make these projects happen. So just be prepared. It's going to be a lot of work, but it's not impossible. I mean, if you want to do that, by all means.
Okay, yeah, good to know. Makes total sense. I mean, as everywhere, that once you figure out the details, you figure out it's expensive as well. And if you
E-
know the details, you can probably at least avoid some of it or handle it in a better way.
Exactly. And look, it's all choices, right? I mean, everyone lives a different life. We're all in different seasons, and some people they find the thing that they're really good at. Like if you're a really great coach for like business owners, like why not do more of that? Like your incremental time you spend on that will generate you exponentially more returns than it is to learn something new, take on a risk, sign on to a loan, qualify for a loan, find a deal that makes sense, and like do all that stuff. So, that's why like most people do that, and it's like
Right.
it's a sensible choice for a lot of people. But yeah, I mean, some people do give it a shot.
Yep, makes total sense. I'd be curious. So, as the last question for this podcast, with all the experience that you have, everything you have done, and let's say we're speaking to somebody who is thinking to make either the first or the next real estate investment, whatever that might be, but maybe sit on the fence, not sure how to make a good decision about making a real estate investment or not. What would you say is a good way to make that decision in case there would be some steps to that, for example, or a framework or something like that?
Yeah, yeah. And to that, I would say education is key. An educated investor is an informed investor, and in this world, the better decision that you make, the better outcome on average that you get. So, that's one thing that I did when I was an investor. Like I read up everything I can. I was like in all the forums. I was watching YouTube videos. I was reading books to learn everything I can, talking to people, like seeing how I can help them out, and like just figuring out ways to learn more. So and also like of course like paying for like coaches, masterminds, like all that stuff. Like I spend like easily six figures into like my own sort of extracurricular development essentially. And it is worth it. It is the long game. But, if there's, on the other side, like, look, if you're interested to invest, if you want to learn more, something that we really emphasize at our team is investor education. So it's basically like you can learn basically on the sidelines and not be obligated to anything, and there's no cost to it. We just want to make you an informed investor. So we have a lot of resources that we can share, including like, oh, hey, how do I analyze a deal? What are the tax benefits? Like, why should I do this? What's like the returns of the public markets versus private markets? And we have all of those resources. We're happy to share it. Just reach out to us. Check out our website, and we'll get you hooked up.
Wow. Yeah, good to know. Appreciate it. Thanks so much, Leo.
Yeah,
Also, especially now, the very last thing, in case somebody wants to get in touch with you and potentially also the opportunities you can provide, what would be
yeah.
the best way to do that?
Yeah, so there's two ways. One is to reach out to us on our website, cornellcommunities.com, spell it out. And the other one is you can reach out to me on LinkedIn or Instagram. On LinkedIn, it's Leo Young, Young. On Instagram, Leo Young Real Estate. And one thing that is important to know is that for the investment decision, I mean, it's not an easy decision for a lot of people. So, most of our investors, like they sit on the sidelines, they learn for some time, they talk to our team, they sort of learn it better, and then they invest. It's not like, right away they do it. So we have a lot of free resources that we can share with you in our investor community. So I encourage people to join and to ask any questions, and we're an open book, but we want to help you succeed.
All right. Sounds great. Thank you very much for that. And again, also, especially, Leo, appreciate you taking the time and educating us in this case about what you're doing and what the opportunity is, how it looks like. And I learned a lot myself right now as well. Appreciate it. Thanks,
Excellent.
and excited to see you
Yeah.
again. Cheers.
Yes. Thank you so much, Robert. And I appreciate all you listeners, and any questions, reach out to us.
Go to rockandrollyourdreams.com/podcast.